The smartest thing you can do right now if you are thinking about buying a house in 2026 is wait for mortgage rates to come down. That is the line. You have heard it from your coworker. You have seen it in Reddit threads. Your uncle said it at Easter. And the logic feels airtight. Rates are sitting near 6.5%. The Fed has not cut all year. Markets are pricing in zero cuts for the rest of 2026. So you wait, you save more. Rates come down a point or two. You buy the same house for less per month. Clean, simple math. I believed that math too, and then I started pulling the numbers apart. Before I go any further, I want to be clear about something. I am not a financial advisor. I do not know your income, your debt, your credit situation, or your timeline. Nothing in this video is a recommendation to buy or not buy anything. This is math, public data. You take it, you check it, you make your own call. Now, the question that is going to run through everything you are about to hear is one sentence long. Should you lock in a mortgage rate near 6.5% or wait for rates to drop? And I am going to walk you through three versions of the answer: the popular one, the expert one, and then the one I found when I stopped looking at rates and started looking at total cost. Let us start with the popular answer because it is the one that feels the most obvious. The average 30-year fixed rate as of April 9th, 2026 is 6.37%, according to Freddie Mac. A year ago, it was 6.64. In the spring of 2022, it was hovering around 5. In 2021, it touched the high twos. So the logic goes, rates have been lower before, they will be lower again, and every percentage point you wait out saves you real money. And that is not wrong. On a $400,000 home with 20% down, the difference between 6.4% and 5.4% is about $200 a month. Over 30 years, that adds up to roughly $73,000. Not nothing, not even close to nothing. So you open Zillow, you save a few listings, you close the app, and you wait. Nobody talks about this part, the waiting, the checking Freddie Mac's weekly average every Thursday morning, like it is a test result. The mental math in the shower, the slow, private negotiation between what you want and what the spreadsheet says you can afford. This is where the popular answer starts to crack. The Mortgage Bankers Association forecast, published in October 2025, puts the 30-year average at 6.4% in 2026 and 6.3% in 2027, rising to 6.5% in 2028. Fannie Mae is more optimistic. Their March 2026 forecast calls for 5.9 in Q2, 5.8 in Q3, 5.7 by Q4. But even that optimistic scenario does not get you below 5.5. And this is where most people stop reading the forecast. They see 5.7 and think, great, I will wait for that. But 5.7 is an average. That means half the weeks could be above it. It means your rate on your credit profile, with your down payment, in your zip code, might still be 6.1 when you finally sit down to sign. The number in the headline and the number on your rate lock are not the same number. But okay, let us give the waiting strategy its best case. Let us say rates genuinely hit 5.5 by sometime in 2027. That is a full point below where they sit today on paper. That is the dream. Now, let us talk about the answer you get from people who watch this market professionally. And this is the part that started to bother me. The Federal Reserve held rates steady at 3.5 to 3.75 on March 18, 2026. The vote was 11-1. Markets, as of late March, are pricing in a 75% probability of zero rate cuts for the rest of the year, according to the CME FedWatch tool. Goldman Sachs pushed their first expected cut from June to September, citing a higher inflation path. The Fed funds rate and the mortgage rate are not the same thing, but they pull on the same rope. When the Fed stays put, long-term rates do not have a strong reason to fall. Meanwhile, house prices did not get the memo that transactions are frozen. Existing home sales in 2025 totaled 4.06 million units, according to the National Association of Realtors. That matches the lowest annual volume since 1995. Let that sit for a second. The fewest homes changing hands in 30 years. And in that same environment, the FHFA House Price Index still rose 1.8% year over year through Q4 2025. Those two facts should not coexist. Lowest transaction volume in a generation. Prices still going up. It is like a store with no customers where the owner keeps raising the sticker price. And somehow, it is working. That is not a broken market. That is a market with a supply problem so deep that even frozen demand cannot bring prices down. And every institution with a financial stake in your decision, every lender, every listing platform, every real estate marketing email in your inbox has a structural incentive to tell you now is a great time. None of them make money when you say no. And this is where the conversation usually ends. Popular answer says wait, expert answer says the market is stuck. And you are left scrolling through listings at midnight, not buying, not buying, just hovering. But this is the part that actually changed how I see this. Everything I just told you, that was the surface. The real question is not what your mortgage rate will be. The real question is what the house will cost by the time you get that better rate. Let me run the math. And I mean all of it step by step because I want you to see where the money actually moves. Scenario 1. You buy today, April 2026, median home price. Let us use the Census Bureau's January 2026 figure for new home. 400,000 even. You put 20% down. That is 80,000. You finance 320,000 at 6.4%. Your monthly principal and interest payment is $2,001. Over 30 years, you pay a total of $720,360. Your total interest cost is $400,360. Big number, ugly number. I get it. Scenario 2. You wait 18 months. It is October 2027. Rates have come down to 5.5, which is better than even Fannie Mae's optimistic forecast. But the FHFA says home prices rose 1.8% year over year through Q4 2025. Fannie Mae SQ1 2026 home price expectations survey projects 1.8% appreciation in 2026. Let us be conservative and call it 3% total appreciation over those 18 months. Your $400,000 house now costs $412,000. Your 20% down is $82,400. You finance $329,600 at 5.5%. Monthly payment $1,871. You are saving $130 a month. Over 30 years, that is $46,800 in total payment savings. But you paid $12,000 more for the house, and your down payment went up $2,400. And for 18 months, you paid rent instead of building equity. Let us put a number on that rent. The national average for a one-bedroom apartment was $1,627 a month as of March 2026. According to apartments.com, over 18 months, that is $29,286 in rent you will never get back. Zero equity, zero tax deduction, just gone. So the real math, you saved $46,800 in interest over 30 years. You spent $12,000 more on the purchase price. You spent $29,286 in rent. You put up an extra $2,400 in down payment. Add it up, and the net benefit of waiting is about $3,000 over 30 years. $3,000 for a year and a half of your life, under the most generous rate scenario anyone is forecasting. And that $3,000 evaporates the second any single assumption moves against you. If prices go up 4% instead of 3, you are already underwater. If rates only drop to 5.8, which is exactly what Fannie Mae is forecasting for Q3, the monthly savings shrink to about $60 and the total cost of waiting turns negative. That is the number that stopped me, not because it is enormous, because it is almost nothing. The entire upside of waiting 18 months under perfect conditions fits inside 1 month of rent. Nobody shows you the total cost comparison. They show you the monthly payment comparison. And those are two completely different pictures. Let me show you what this looks like on an actual person. Riley, 29, works in supply chain logistics in Columbus, Ohio, earns $71,000 a year, credit score 742. Has been renting a one-bedroom for $1,680 a month, saved $43,000 over 4 years. Has not taken a real vacation since 2023, drives a 2019 Civic with 114,000 miles on it. Checks mortgage rates every Thursday. Riley ran the numbers last September when rates briefly touched 6.1, got pre-approved, found a place in Westerville listed at 385, could have put 15% down, carried PMI for a few years. The monthly would have been tight but workable. Riley did not pull the trigger, decided to wait for 5-something. That was 7 months ago. The same house in Westerville, same floor plan, same carpet, same school district, rated a 6 out of 10 on a generous afternoon. Same yard the size of a generous parking space is now listed at 397. Riley's savings have not grown by $12,000 in 7 months. The gap widened while Riley stood still. By every reasonable standard, Riley is exactly the person homeownership was supposed to work for. Steady job, good credit, years of discipline, and the reward for patience is a target that moves further away at the speed of 1.8% per year. You have done this, maybe not with a house in Westerville, but you have opened the app, seen the rate, done the mental math, closed the app, and done nothing. Not because you are lazy, not because you do not understand the numbers, because the numbers do not give you a clean answer, and nobody in your life is going to sit with you at the kitchen table and run both scenarios to the penny. Now, I need to be honest with you because this is where the story flips. I just spent 10 minutes making the case that waiting costs more than locking in, and the math, as I showed it, supports that conclusion under specific assumptions. And those assumptions are doing a lot of work. I assumed prices go up. They usually do, but they do not always. The Census Bureau reported that the median new home price in January 2026 was $400,500, which is 6.8% below January 2025, according to their monthly new residential sales report. New home prices fell year over year. That happened. Not everywhere, not for all categories, but it happened. I assumed rent is dead money. But if you take that $1,600 a month and invest the difference between renting and the true all-in cost of ownership, taxes, insurance, maintenance, AOA, the math changes again. Homeownership has costs that do not show up in the mortgage calculator. A roof does not care what your rate is. It leaks on a schedule of its own. I assumed you stay for 30 years. Almost nobody does. The typical homeowner stays in their home about 12 years, according to a March 2026 Redfin report. If you sell in 7, the interest savings from a lower rate and the equity drag from a higher purchase price interact differently. The break-even shifts, and I assumed you can actually get that 5.5 rate when it arrives. But that rate will come if it comes in a market where everyone else is also waiting for it. The same rate that unlocks your buying power unlocks everyone else's too. More buyers, same inventory. The supply problem does not fix itself because rates dropped. It might actually get worse. Someone who has started a bonfire and is now slightly worried they may have used too much lighter fluid. So which scenario is right? Both, neither. It depends on variables that no one in a YouTube video, including me, can calculate for you. How long you will stay, what your local market does, what your rent is, what your alternative investment returns would be, what your tolerance for a payment that feels tight for the first 3 years looks like. The honest answer, the one that nobody wants to give because it does not make a good thumbnail, is that the rate is not the decision. The rate is one input in a decision that has about 15 inputs, and most of them are personal. 1% 30 years on $320,000. That is roughly $75,000 in total interest difference. That is not an opinion, that is arithmetic. But arithmetic without context is just a number looking for a story to attach itself to. April is the start of spring buying season, but the math works exactly the same in September, and it will work the same next April too. The point is not timing the market. The point is knowing what you are actually timing. If rates are still 6% in 18 months and the house you want costs $15,000 more than it does today, will you wish you had moved now? Or will you have used that time to save more, pay down other debt, and put yourself in a position where the rate matters less because your down payment is bigger? That is not a mortgage question. That is a question about what you are willing to trade 18 months of your life for. And the answer lives in a spreadsheet only you can build.